Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Thanks for joining us here at Ausbiz. Let's get across what happened overnight on markets. Fairly mixed session as chipmakers recovered some of their recent losses. Oil prices continue to climb as Yemen's Iran-aligned Houthis declared a naval blockade against Saudi Arabia. Wall Street's major indices finishing lower as the Middle East tensions weighed on investors' minds, while they also looked ahead at earnings reports due from the major tech companies later in the week. Now, among them, Alphabet, shares of which gained on a report that the company is developing a server chip designed to optimise its Gemini AI model by improving efficiency and easing computer capacity constraints. Domino's shares finished up after the pizza chain's quarterly revenue edged past estimates while it maintained its annual sales forecasts. Apple was the biggest drag on the S&P 500, while the biggest boost came from Microsoft. And investors are awaiting results from chipmakers such as Intel and Texas Instruments, after the Philadelphia Semiconductor Index ended last week more than 20% below its late June record high, confirming a bear market decline. Shares of Iron surged 20% after the NASDAQ-listed AI data center operator said it signed a $2.8 billion, that's US dollar, worth of new contracts with leading AI developers. And a US court has temporarily paused Paramount Skydance's $110 billion takeover of Warner Brothers Discovery, saying it likely violates antitrust law. And Europe's largest airline by passenger numbers, Ryanair, reported an after-tax profit that missed forecasts and warned that its average fares are set to be modestly down on the previous year due to uncertainty around the Iran war. Well, Yemen's Iran-aligned Houthis have said they will impose a naval blockade on Saudi Arabia, further raising the threat of global energy supplies and trade beyond the Gulf. Iran had been pressing the Houthis to close the Bab el-Mandeb gateway to the Red Sea if the US continued to attack Iranian power infrastructure. Meanwhile, in the UK, Andy Burnham has become Britain's 7th Prime Minister in a decade and has pledged to deliver a new economic model. He unexpectedly named former Defence Secretary John Healey to be his Chancellor of the Exchequer, prompting speculation about a bigger increase in military spending. Well, benchmark British borrowing costs rose and sterling dipped on expectations the new Prime Minister would adopt a looser fiscal policy. And in the US, Treasury yields rose as oil extended its recent gains. The US 2-year up to 4.23%, the 10-year at 4.6%. Australian 3-year government bond yield futures rose to 4.59%, the 10-year back above 5%. And the US dollar index up 0.33%. The Aussie currently trading at 70 US cents. Well, oil prices rose in a volatile trading session as the market considered the threat posed by Yemen's Houthis. Brent crude futures up 1.3% at around $89 a barrel. Gold edged lower to be just over $4,000 an ounce. Copper futures rose 1.5%. Iron ore fell 0.5%, $101 a ton. And Bitcoin is currently trading above $65,000. Well, US earnings season is gathering pace, with corporate America so far proving more resilient than many had expected. Earlier I caught up with Kevin Hebner from TD Epoch and asked him what he's looking at in particular amid the results.
Percent of the S&P 500 companies report so far, particularly from the financial sector, and those numbers came in very strong. And we're tending to see the Q2 year-on-year numbers get revised up, now expecting overall about 25% year-on-year. So corporate America is doing very well. The economy is strong, and we start to get tech companies report, Tesla, Alphabet, and then more coming next week. And their guidance for Q3 and beyond, I think, is going to be very important, and what their plans are with AI, and particularly the capex plans with AI. Because the last quarter, the hyperscalers, the big 5 companies, they were forecasting AI capex of coming on $1 trillion next year.
It is quite incredible, those numbers, in terms of the money being spent at the moment. And of course, that's the issue investors are having increasingly at the moment as to how this is going to pay off. Where are the returns coming from?
Yeah, and I think there's 2 issues with that. One is the open models being released from China, and that will challenge the approach from companies like Anthropic and OpenAI. We should be having IPOs maybe in September for Anthropic, a little bit later for OpenAI, and they're now being priced at about $1 trillion. So if they do have open weight challengers, people will be wondering about those valuations. The other thing is with SpaceX. So it came to the market. It's a leader in its sector, but at a very rich valuation, trading, depending on how you look at, almost 100 times sales. And since the IPO, it's down. It's trailing the S&P since the IPO by just over 10%. So pretty big markdown. And I think a lot of that reflects two things. One is the valuation, the price of sales is so high. The other thing is the public float at the IPO was just under 5%. So just under 5% of shares were publicly available to be traded. That number is going to get up to about 50% as insiders and VC companies have their lockups expire. And then a year from now, Elon's lockup expires. So then you go from roughly a 5% float to a float that's about 97%. So essentially, you're going to have 20 times the amount of potential SpaceX stock hitting the market over the next 12 months or so, as happened on IPO day. So it's just a lot to absorb, particularly when you're at such an eye-popping elevated valuation.
And overall, what do you see as the likely strategy there from SpaceX, in particular Elon Musk, with perhaps speculation that Tesla is going to be absorbed into the broader company?
Yeah, so one thing that he's done is he's had this sort of dual class share so that he can own about, just over 40% of the shares, but have 85% of the voting right. So control is very important to him. And that control is very important to any founder. When you go public, the advantage is you get off the hamster wheel of fundraising. And so you have a lot of optionality with financing. The big disadvantage is you lose governance, you lose control, you have an independent board. So Elon will have the control with SpaceX. And when he looks at Tesla, he might be looking if there's some way to combine the two companies and then have overall majority control of the combined entity. I think that'd be something very interesting to him. And that will be a possibility. So his lockup shares in terms of SpaceX ends 366 days after the SpaceX IPO, at which point that he would have the firepower, the ammunition to merge with Tesla and have control over the combined entity.
Kevin, can I just take you back to that point you made about Anthropic and OpenAI with their IPOs expected at the end of the year, and those developments over the weekend from China with Moonshot coming up with that cheaper open source model. What sort of a threat does that pose to those American companies?
So a lot of times in software, you have like an open, cheaper sort of variety. Like if you think about smartphones, we have Android. In fact, most smartphones in the world won't run on Android. And then we have a smaller share that runs on iOS, your iPhone. These are more expensive, more profitable phones. And that would be normal. And so we can imagine the AI foundational model world splitting that way, that a lot of stuff is run on the cheaper open weight models. And then some stuff in which the quality of the product, fewer errors, and that's more important. For example, if you think about autonomous vehicles, drones, things like this, robotics, and they'd be on the more expensive proprietary type models. So that'd be the sort of, I think, the direction that we're heading to. And it does pose a challenge for Anthropic and OpenAI, and we'll have to see how they respond to that.
And Kevin, can I just take you back to earnings season, what we've seen? Obviously, we began with the banks last week. Some stellar results there. Well quoted that Jamie Dimon from JPMorgan saying it's pretty much as good as it gets. What was your view?
Yes. Well, certainly it was pretty broad-based within each bank and then across the financial sector. So we've had very strong asset market appreciation. It's been good for traders. We're seeing IPO activity pick up. We're seeing M&A activity pick up. So it is a very nice environment for banks. And before results season, people have been thinking financials earnings growth would be about 6% year on year. That's increased up to about 18%. So that's a big pickup. So investors were very happy with the results and the guidance that they've seen from banks.
Kevin Hebner from TD Epoch out of the States. All right, let's now turn our attention to the local market. Ahead of the open here, we are expecting a negative start. S&P SPY futures there down 0.4%. There's a raft of company updates to get across as well. We will do that in just a moment. Stay with us for the open.